All right, so chapter 10. In this chapter, we're going to take our knowledge of what we know from how insurance is kind of bought and sold, and we're going to pair that with some of these kind of moral hazard and adverse selection mitigators that we've discussed before. So there will be some classification, some underwriting that we discuss as well within the contractual side of things. So what we're kind of doing is we're kind of peeking behind the legal veil, okay, for insurance contracts. And we've covered some of that to some extent, like ideas like indemnification, but we'll dive into the actual contractual side today. And we'll go through each of these from declarations to the kind of miscellaneous or ancillary provisions of most contracts. And really what I want to do is just kind of give you guys, again, in an intro class, a bird's eye view of this topic. Okay, we could spend arguably an entire semester, okay, on the legal side of insurance contracts. Okay? Now, while that may sound exciting, we don't have time for it today. So let's get started with what we tend to see on the very first page of most insurance contracts, and that's the declarations page. A very quick way to think about this is the page that tells you the who, what, when, and where. Okay? Who is covered as the insured, what property may be covered, when that coverage is offered, and where that coverage is good. It's often the first page of a contract. Often the first page of a contract. So what would this look like? So I went on Allstate's website and pulled their first declaration page for a traditional auto policy. This is not proprietary information. This is free to find on Allstate's website. In fact, it has a fake name. Okay? So this is not information that you're not privy to. Okay? And what we can see here is just a few things that they've outlined A through E. So A is kind of telling us the what is covered. And it might be difficult to see if you're watching this online or you guys just out there in the classroom. But A is going to be the vehicle that's covered. We'll say it's property that's covered. Okay. B is our base premium. C and D are the combination of any discounts. It could be endorsements or riders or addendums, but here it's just discounts. So we see like maybe a safe driving club, so a safe driving discount. Okay, and these tack on or remove from the rate or the premium. And then finally E, we get the who. Who is insured? In this case, Jane A. Sample. What a wonderful name, right? Jane A. Sample. So this is just a brief kind of overview of what on your auto policy. Relatively speaking, what you would see. Now, I have a State Farm policy. It doesn't look exactly like this, but I can find A, B, C, D, and E on that first or second page. Now, there tend to be other pages as well. It's rare that it's just one page because we're missing a couple of things here because I do not see the coverage limits, liability from property damage or anything like that. Okay, so there's surely another page to this. But there you go, a brief overview of the declarations page. Now, definitions are also often paired with this, kind of a supporting document, or it's all in one document with a supporting page. And briefly here, I don't think we need to dive much into this. Definitions are definitions. But it's important. It's important. Because your covered auto might not be the same as my covered auto. You might drive an Accord. I have a Tacoma and a Camry. Right? Maybe I like Toyota. But we have to define these, right? What is your covered auto? Are you the insured on my policy? No. Okay. Now, within this, we see the kind of binding agreement, the insuring agreement. So this is mostly the promises of the insurance company or the insurer. And we tend to have what's either called a named peril or an all peril policy. Sometimes you'll see this called all risk or named risk. And recall, a peril is the cause of a loss. So for a named peril policy, It is basically as stated. The insurance companies say, here are the exposures, or the perils that we cover. Look at a homeowner's policy. You'd have a certain itemized list of things that could be covered if it's a named perils policy. Conversely, if it's an all perils or all risk policy, the listing is what the insurance company is not going to cover. So if we're looking at homeowners, flood and windstorm tend to be excluded. Now, the burden of proof here, the way that it's mostly different is that it's just shifted from one party to the other. So it's really just that it's shifted. For the named perils, we tend to think that this is for the policyholder, the insured or the insured. So you have that policy. You have to say, hey, look, no, this is on the list. So you have to, we could say, prove that the loss is a named peril or risk. On the other hand, with an all risk policy, the insurance company has to say, no, it's on this list, so we're not covering it. We're not covering it. Now I get to deeper discussion about what's omitted and false positives and false negatives, but really here's the burden that's been shifted from one party to the other. So named perils, that's the policyholder, the insured. All risk, that's going to be the insurance company or the insurer. Now, some common exclusions. So an exclusion, we would see this maybe in a named peril policy, and then you have things that are not covered, perils that are not covered. So I've already covered flood in a homeowner's policy. Another example would be suicide in a life policy is not covered for the first 2 years, and with many or a few exceptions. Some states it's 1 year, okay, but it can't be more than 2 years. So that would be a peril, but there can also be excluded losses and or property. Excluded losses here, business income insurance on your homeowner's policy. So if you're running a business out of your homeowner's is not going to cover much, if any, of the losses due to that business. So if you have some inventory in your garage, something happens to the garage, fire, even if fire might be a covered cause of loss, the type of loss, in this case, your inventory for your business that you're holding in the garage, may not be covered. Rarely would be. If it is covered, it's going to be to a lower limit. Why? Well, you could get that policy elsewhere, a business policy. Excluded property. Again, if we're sticking with homeowners policies, if you go out in your car and get into an accident, your homeowners policy is not going to cover it. Planes, animals, in this case it could be pets or it could be livestock. So you have pet insurance or farm insurance. So why do we see some of these exclusions? Well, some perils are not ideally insurable. Flood, perfect example of that. That doesn't mean you can't get flood insurance. It's just not an ideal risk to insure. Some hazards are extraordinary. This is also related to they're not needed. So an example, if it's both of those, would be like aviation insurance. So I had an example of your plane being covered on a homeowner's policy. Well, you can get aviation insurance. Okay? It's also not a common need. Okay? I don't have a jet in my garage. There could just be coverage offered by other contracts. The business income insurance is a great example of that. Could be moral hazard problems. That pops up frequently. In fact, a lot of these addendums or things that we do find in these contracts are meant to mitigate moral hazard and or adverse selection. So there's some reasons we see exclusions. Now, conditions, okay, are based on the promise to perform. So the insurer, okay, promises to perform provided or on the condition they are notified of losses. They're not going to go looking for losses. It's rare. Why? I mean, they're a business. I don't have a lot of confidence in a business that's going to go looking for expenses. However, there's some protection. Let's say that you're in a flood zone, you have a homeowner's policy, you own a home in a flood zone. Okay, that's unfortunate. Let's say that waters are rising, there's a flood, and you know that it's probably going to get into your living room, but maybe not, let's say, your second floor. You have a second floor. If you try to save some of your electronic devices, let's say your nice new 65-inch 4K big screen TV. If you try to save that, let's say you're going to walk up the stairs with it. Well, it's 65 inches. It's pretty cumbersome. The TVs aren't as heavy as they used to be, but they're still 65 inches. I think is still 65 inches. I don't think that's changed. So if you're carrying that up the stairs to save the property, because if it sits there, it's going to get damaged, and you drop it, and it falls and shatters, well, you'll probably be covered anyway. Why? Because it was going to be destroyed regardless. You're only trying to make or trying to protect from a loss, which means you're trying to save yourself money, but also the insurance company some money. Okay? Now, one side that could be a pro or a con is when it comes to subrogation. So we know what subrogation is when the insurance company is going to act on your behalf. You kind of have to cooperate to get full coverage for the most part. It's rare that you can circumvent that. And where that could be problematic is in malpractice suits. So we talk about one of the big expenses for a lot of doctors is malpractice insurance. Okay? Not necessarily because it's a poor insurance product. In fact, the actuarial values on them are fair to pretty good. The problem is malpractice suits are exorbitantly expensive. We sue for pain and suffering, it can be in the millions. And while doctors on average are fairly wealthy, in the millions is still a very big hit for almost anyone. 99.5% of people would not want to pay that out. Okay? But the issue is that it's often cheaper to settle out of court. You might, as a doctor, you might not want to settle out of court because you think it signifies to the general population that you're guilty. Is that true? No. But would people perhaps think that? Yes. So that's kind of a decision that has to be made. Okay, so it's not always great. Oftentimes it is, though. Oftentimes this is a bonus. For most people, they don't have to deal with the subrogation part. That's what the company does on your behalf. Okay, but it's not always great. Now, a few miscellaneous provisions I want to hit on here. For property casualty, the assignment of the policy, again, think when insurable interest is. You show insurable interest in a property casualty product, and you need to have it at the time of the loss. Okay, so they're not necessarily freely assignable. Cancellation, if you don't pay your premiums, that's one way to cancel. Okay? If you don't pay your premiums, you don't have coverage. And unless there's a law requiring you to have coverage, you're not going to see any financial penalty for not paying that premium. You just don't have coverage. Now, other insurance provisions allow for you to get excess coverage on top of your base policy, similar to reinsurance pools. With life health insurance, a couple things I want to mention, and this is true for both of them. You have grace periods and the ability to reinstate a lapsed policy. So grace period is if you're late on your payment, you still have coverage. So you still have the policy in force, life or health. So if you're, and most states put these at 30, some at 60 days. So you can be up to a month, maybe two, late, and you still have your life policy in force or your health insurance policy in force. Reinstatement of a lapsed policy, this is more life insurance. If you don't pay for, let's say, 3 months, 6 months, you can still reinstate the policy. Why? Well, you haven't suffered a loss. Okay? If you can walk into your agent's office that you purchased a life insurance product from, you have not suffered a loss. So it's hard to say there's a selection or moral hazard issue there. There could be, but not likely. If you're alive, your life insurance policy, they can reinstate it within legal requirements. Usually 90 days is what we tend to see. Okay? All right, so let's talk about additions to these policies. Technically, there's a difference between endorsements and riders, but in practice, they're sometimes used synonymously. Okay? They're sometimes used synonymously. An endorsement is just an addition to a property contract or a property insurance contract. So that's an endorsement. A rider is an addition to life or health contracts. They do the same thing, which is oftentimes why you hear them, kind of used synonymously. Technically, they're not the same thing. Okay, so now the bulk of this chapter really is on deductibles and coinsurance. Okay? So let's start first with deductibles, and we're going to discuss how they can be different in property and life, and then we'll move to coinsurance, and we'll see that they are very, very different between property, casualty, and then life or health insurance. Okay? Now, we can go ahead and throw out life insurance with both of these. Life insurance contracts are valued policies. So if you impose a deductible or some type of coinsurance, let's say it's a $50,000 deductible, and we want to get $200,000 in coverage, well, we're just going to buy $250,000 in coverage. So it doesn't really make sense. Okay, there are other reasons, but that's one too from a practical standpoint. So really we're just going to look at property and health. Life and liability, we don't generally see deductibles, if ever. So what is a deductible? It's a flat amount that the insured or the policyholder must pay before they are reimbursed for any loss. So if you have auto policy, more than likely you have a $500 deductible. So every time within the policy period that you suffer a loss, you're going to have to pay $500 of that loss. Now there's an inverse relationship between deductibles and premiums, all other things constant. You raise your deductible, you're going to have to pay more on a loss. The actual value of the policy is a little bit lower, and the premium's lower. If you lower your deductibles, then premiums tend to go up. Now, this might not change as much as you would think. So I have one example here, but it depends on the policy. For a personal auto policy, you might not see that big of a change going from a $500 to a $1,000 deductible because most of the losses, as far as the total amount is concerned, in an auto policy come from the liability side of things, not the property or the collision side of things. But it depends on the contract. So why would we see this? Eliminate small claims. Every time a claim is made, there are certain fixed costs we must go through. Whether it's a $5 claim or a $500,000 claim, there's some fixed costs attributed to it. So we have to do this for even those $5 claims, then those are more expensive per loss amount, and therefore less efficient to process, making the market less efficient, making the pricing less efficient, making these products less desirable for people like you and me. Reduce moral and or morale hazard. If you have complete full coverage, meaning no deductibles whatsoever, we know that there can be some overuse and moral hazard, or that's in health or property. And we know that those drive costs up as well. And then there's some flexibility. Maybe I'm like, okay, I want my deductible to be $2,000. It'll drop my premium. Maybe I want that. So it allows for some choice. We see that in coinsurance too, though oftentimes coinsurance is not selective from the policyholder side. But these kind of hold true, at least for the moral hazard and flexibility for coinsurance as well. All right, so two types here are straight and aggregate deductibles. A straight deductible is for every single loss. It's a per loss deductible. Your auto policies are like this. Every time you get in an accident with a straight deductible, every time you get in an accident, you're going to have to pay that deductible, even if it's a day or two after the fact. You probably need to take a break from driving if that's the point, but it's every one, every occurrance. With aggregate, This is for the policy period, and this is far more common in health insurance. So you have a $3,000 health insurance deductible. You don't pay that every time you go, or you don't have to hit that every time you go to the doctor or get an MRI or CT scan or surgery. Every time you pay to one of those covered losses, it adds up to that total deductible. Once you get over that, you've met it. Everything else is covered, ignoring co-insurance. So let's talk about how it works in health insurance. If we have a $1,000 aggregate deductible, I've listed here a number of losses covered across the policy period. We can assume that they're covered. I have in the second column here the total loss, and then how much the insurance company is going to pay. So once they get to 1,000, then the insurance company starts paying. So we know that for these first three losses, we're only at $850. This is all out of pocket for us as the policyholder, if you have this health insurance policy. However, this fourth loss of $500 puts us at $1,350. Within that first $150, we're done. We've paid our deductible. Anything after that, ignoring any co-insurance clause, anything after that, the insurance company is going to pay. This resets at the end of the policy. So if the end of the policy is December 31st, then it resets on January 1st. So that's how a health insurance deductible works. Now, what we generally see, again, in property is that straight line. Okay, so it's a little easier. Per loss is the $500. I don't have a specific example of that. Right. Now, we also see an elimination period in some contracts, usually long-term disability, perhaps in workers' comp, where there's more asymmetric information. So with certain injuries, back injuries, great example, there's asymmetric information. Okay. Someone can be barely unable to walk because their back is bothering them so much, but it might be very difficult to figure out exactly what's causing that, or even exactly how to fix that. Okay, back injuries are very, very tricky. They could also be lying about it. That's the problem. Okay, does that mean everyone with a back injury is lying about it? Absolutely not. But it's greater than zero. So there's an elimination period. Why? To reduce moral hazard. Now let's move to co-insurance. Okay, so co-insurance and property insurance is kind of a requirement for the base amount that you must have covered before you see a certain percentage of coverage for your losses. And actually, it's a pretty straightforward formula. The way I like to think about this is, what did you purchase and what should you have purchased? So did over should. If you should have purchased, let's say, $400,000 in property damage coverage, if that's what you're supposed to purchase based on the contract and the value, and you only purchased $300,000, that's 3 out of 4, that's 75%, so you have 75% coverage after your deductible. Now, the required percentage here, this is set in the contract. So this denominator is something that is set in the contract. And it's almost always a percentage of the value that you want to insure. Common ones are 80%, 75%, 85%. It doesn't usually go much outside of that range. What that means is if it is 80% and you purchase 80%, so if it's $500,000 of property and you're supposed to have 80% coverage to get full coverage, which sounds nice, you need $400,000 coverage. And we'll talk about why that's allowable in just a second. But let's go through a quick little example here, and I'll provide you guys a worksheet with the key, and then we'll probably have time in class to go over this more as well. But today I just want to go through it to kind of get the basic idea of co-insurance and property insurance. Okay? So let's say they require 80% of some attributable value. Could be replacement cost, could be market value. You need 80%, okay, of what we think it's going to cost to replace this. Right? Using the same examples I actually gave you guys earlier, they're saying replacement cost is $500,000, so $500,000. You need 80% of that to get full coverage. So what would that be? You need 400,000. So again, that's the same example I gave. What did you purchase? 300,000. So you're really at 3/4 or 75% coverage here. So if you have a loss, let's say a $100,000 loss, right? You have a loss, that is only covered at 75%, and then your deductible is still removed from it. So it's 75,000 less your deductible, you get paid out 74,000 for a $100,000 loss. So then you might say, well, number one, why would a company or a firm or a person, why would they buy this policy? Or why would they choose to essentially underinsure, we could call it? Why would they choose to underinsure? And why would the company let them? Well, one, it allows more choice, allows us to create some equity in rating. So recall, equity in rating is about fairness across all risk classes. We note that people that tend to want full insurance tend to also need it. But the thing is, most losses are not total losses anyway. So if we require you to have 80, 85% coverage, we're kind of banking on you're not going to need the full 100%. Now, if for some reason we allowed you to purchase that $300,000 of coverage and say that's good enough, we'll pay for full losses, that could create moral hazard issues. Okay? And if everyone insured for partial losses and we didn't have this co-insurance formula to kind of keep them in check, so you're 75% insured, why are we going to pay 100%? If we didn't have something to keep people in check, we'd have to charge more. And it could be that we're, definitely charging more than the expected loss, which is not ideal. Okay. So that's co-insurance for property. Again, we have that formula. We have to know the percentage it's in a contract. 80 is the most common percentage. With health insurance, it's quite different. Okay? Health insurance co-insurance is ex post or after the deductible. It's another kind of cost, I don't say sharing or saving, it's a cost sharing mechanism to, again, reduce moral hazard. And in fact, caps are required. So you can only pay so much per policy period out of pocket before the health insurer that you're using has to pay for everything after that. As of 2021, it's going to be $8,000 per person, $16,000 for a family. So if you're the combination of deductible, co-insurance, if that gets up to $8,000, you don't pay a dime for any covered loss after that. So it's out-of-pocket limits. But let's look at co-insurance instead. Let's say we have that $1,000 deductible, an 80-20 cost sharing. So 80% is going to be the insurance company. 20% though, if we have this policy, we're going to have to pay for 20% of every loss after the deductible. Okay. Up to $3,000. So I've kind of set up something similar to that prior deductible and health insurance column and rows. So we have column one, the claims per claim. We have what the insurer pays and insured, or policyholder. So maybe you can put yourself in this position here. Think about it from your perspective. And then the total that you, the insured, would pay. So through each loss, we see nothing happens for the insurance company prior to the deductible. After the deductible, though, every dollar, the insurance company is going to pay 80 cents, and you are going to pay 20. So, kind of briefly work through the math in the third row here. And what we have to keep in mind as we move through each of these, so we have this 2,750 loss. It's 80% of that, the $2,200, is paid by the insurer. The other 20%, the $550, paid by the insurer. But what happens when we get to this $7,500 loss here is that we hit the out-of-pocket. We hit the out-of-pocket. Meaning that any loss in this policy period after this $7,500, any loss after that, the insurance company is going to pay for it. And again, there will be worksheets and keys, and we'll spend some more time in class going over these examples too. All right. Now, the last little point here. So I mentioned that there can be provisions for other insurance coverage. The three most common ways we see a combination of other insurance coverage are pro rata. So this is equal this is proportionally shared. We have equal shares, which is a flat amount of the coverage until we reach some limit. And then primary excess. And primary excess is kind of like an excess of loss reinsurance policy that we work through, except now it's not necessarily a reinsurer. I'll give you quick examples here. Let's say that if we're looking at prorated, we have three insurers, A, B, and C, offering X hundred thousands of dollars in coverage. So 100, 200, and 300,000. So A's proportion is 100 out of the sum of the total there, which is 600. So they pay 1/6, okay, of any loss. So if there's a $60,000 loss, they pay 1/6 of that, which is 10. B is going to pay 200 out of 600, or 1/3. 1/3 of 60 is 20. C is going to pay 300 out of the total 600 coverage, which is half. Half of the $60,000 loss, 30,000. Okay, so it's just a proportional share based on the coverage. If we're looking at equal shares here, it's equal percentages of the loss regardless of the coverage, and it's only limited by the total coverage offered by each insurer, A, B, and or C. So A is never going to pay more than 100, B never more than 200, and C never more than 300. So if they have the $60,000 loss, it's a 20-20-20. However, 400, that would require about 130, 3 and some change for each of these. But that will put A over their limit. So what happens is A pays up to their limit, and then B and C equally split the remainder. And then finally, primary excess. Again, you can think of this as kind of an excess of loss reinsurance policy. If you have A and B, A covers everything up to 100. B covers everything over that up to a total from B of 500 or a total loss of 600. So I'll give you a final example here, a $250 loss. A pays up to their limit of 100. B covers the rest of 150. If you have a loss of above 600, then you would have to pay for anything above 600. Okay. Questions about Chapter 10?